Markets do not destroy most portfolios. People do, not because they are careless, not because they lack intelligence, but because in moments of uncertainty, they start making decisions they would never make in calm conditions. I have seen this happen repeatedly. A calm, rational investor with a clear long-term plan suddenly feels the urge to do something, not to improve the portfolio, but to reduce discomfort. And that is where damage begins. I am about to show you 5 actions that quietly damage long-term returns. When markets fall, this is not about predicting markets. It is about protecting you from yourself. Let us begin. The first step: pause before you act. Pause does not mean denial. It means delaying irreversible decisions until your nervous system settles. Because the first instinct is often the most expensive. For example, you read alarming headlines. You open your portfolio. You see red numbers. And suddenly, doing nothing feels irresponsible. Selling feels like control. But most of the time, it is emotional relief. And here is what that can cost you. You lock in temporary losses. You interrupt long-term compounding. You convert volatility into permanent damage. So instead, introduce friction. A simple rule: wait 48 hours before making any sell decision. That pause alone can save years of progress. Now the second step. Before you check your portfolio, check your liquidity. Volatility feels dangerous when your survival feels connected to your investments. If your reserves are unclear, a market drop feels like a threat. But if your short-term needs are covered, volatility becomes information, not danger. So before checking performance, check stability. Now the third step. Zoom out deliberately. When markets fall, your time horizon shrinks. A 1-week drop can feel like a long-term collapse. But that is perception, not reality. So zoom out intentionally. Look at long-term charts. Restate your time horizon. And ask yourself, has anything fundamentally changed? Or just the price? Now the fourth step. Rebalance. Do not react. There is a difference between adjustment and reaction. Rebalancing is structured. Reacting is emotional. If your allocation drifts, you adjust gradually. But selling everything at once is not strategy. It is discomfort management. And finally, the fifth step. This is the one most people overlook. Stabilize your life, not just your portfolio. Because most panic decisions do not start in the market. They start in your life. If your expenses are stretched, volatility feels heavier. If your income feels uncertain, markets feel more dangerous. If you are already tired, uncertainty becomes harder to tolerate. So strengthen your system. Reduce pressure. Build margin. Protect your energy. Because when your life is stable, your decisions become stable. And when your decisions become stable, your investments can finally compound. Let us bring this together clearly. When markets drop, pause before acting. Check liquidity before performance. Zoom out deliberately. Rebalance instead of reacting. And stabilize your life. So your portfolio is not your only source of safety. If this resonated with you, comment the word protocol. Because you are not trying to predict the market. You are designing behavior that survives it. And that is where long-term wealth is built.